Hello everyone.
Hi, Nathan. How are you?
Hello, hi.
Can you hear me?
Yes, Sunil sir.
Hi.
Hello everyone. Good evening. Thank you so much for joining in. Today we have Mr. Sunil Subramaniam sir, right? And I think no one needs the introduction, but again, he deserves it totally. So I will start with. So sir, before we started, let's wait just for a couple of minutes so that more audience can join in, right? And then we can proceed. Just for
Absolutely. No problem.
so let's start. As the meeting is recorded, I think people can also watch the recordings. Right? So I will just take few minutes to introduce our speaker for today. So, ladies and gentlemen, our speaker basically needs a little introduction, but he deserves every word of it. So, Mr. Sunil Subramaniam sir brings around 40 years of remarkable experience in Indian financial services. He has been in the corridors for SBI, United India Insurance to global institutions like Express India, American Express Bank, Bank of America, and finally, he retired as a managing director of Sundaram Mutual Fund. Right, he led the organization for nearly 2 decades. Under his leadership, Sundaram AUM grew from merely 2,000 crore to currently over more than 80,000 crore. Right, that's the CAGR of nearly 21%, which comfortably outpaces the broader AUM growth as well as the Sensex return that market has given. Recognized 5 consecutive years by Economic Times as one of the most Asia's promising business leader. Right, he was a former SEBI Mutual Fund Advisory Board also, and a passionate advocate of financial literacy through his YouTube channel. I think most all the people here should at least go through that YouTube channel. Channel name is Sense and Simplicity. Right, and again, Mr. Sunil sir is the rare combination of market depth as well as he communicates very clearly. Right, we have seen a lot of his podcast with Prince in past also. So with that, giving you a very warm welcome, sir.
Thank
Uh,
you.
Glad to have you here, and your physical experience will help us in understanding and navigating this maybe lot of hindrances that we have been facing. And as a retail investor, hardly any one of them has made money in last 18 months. So with that, my first question would be like to warm up the session is right. You have seen multiple market cycles, right? You have gone through bull runs, corrections, global crisis, right? So looking at where India sits today in 2026, right? Again, there's a lot of global volatility, geopolitical shifts happening in, right? Uh, Indian economy seems strong, but yet cautious at energy crisis, things, right? So how do you characterize this as a moment in Indian market, right? Where we are sitting in, so that we set the context for today.
So I think that to put it very succinctly, right? I think that if you go back a few months before, to the previous RBI policy, not to this one, where the RBI governor called India a Goldilocks economy, right? The war came and then distorted that, obviously. But he called India. And what does that Goldilocks economy mean? Because from an RBI governor's perspective, the growth rate was good, but inflation was low. So why do we see Goldilocks is a situation which really doesn't say sustain in the real world? Goldilocks itself is a fairy tale, right? What it means is that if there is good growth, inflation should go up, right? But we were in a place where the growth was good, but inflation was not going up, right? And the reason for that, very simply, is that India is still a supply driven economy, not a demand driven economy. So, this rule that good growth should be accompanied by high or moderate to high inflation is true of demand driven economies, right? But we are still a supply driven economy. We are metamorphosing into a demand driven over the period of the next decade, maybe, but we are still a supply side economy. So when it comes to that, then two things happen, right? That is, the supply side inflation was low prior to the war. So, which is what one is imported inflation coming in from oil, which was at a sustained last year before the war. People may not like to remember this, but there's a 20% correction in the price of war pre-war if you take 1 year back. Okay, so India had a soft imported inflation, and we had good monsoons for 2-3 years, and food inflation was low. And also the problem was food inflation was too low, right? And so rural economy was getting affected because rural demand was slipping. So why I'm taking you to that context is that this war is a short-term jerk to the economy. The war will go away one day, right? So when it goes back to the situation, right, is India going to go back to the Goldilocks situation? That is, if oil comes back down, maybe it may not come down to 65, 70 levels, may come to 80, 85, right? Will India be again in a Goldilocks situation? I think from our perspective, the answer is no. The answer is no, because like I said, oil itself will not come back to 65 levels, right? And in the immediate period, the sustained effect of this oil price impact will be seen in the economy to some extent. So it will take a minimum of 6 months to 8 months for the economy to come back to a so-called Goldilocks situation. But even that situation won't recur, because if you recollect, before the war, the government was actually trying to, how do I say, reinflate the economy. That's the right way to put it, right? GST cuts, income tax cuts were all in an effort to boost the demand side of the economy, right? Which meant that inflation would go up, right? So that's the better situation to be in than a Goldilocks situation, right? Because the stock market thrives on nominal GDP. So prior to the war, the biggest problem for us was our nominal GDP was going down to 8.5%. Stock market earnings can't grow if corporates are not making enough money, because inflation is low, and hence people, that means people are not buying enough. So, and second is, private capex also to take off needs a moderate inflation, where the capex company which is investing in capex feels that my interest cost will be covered by the rise in prices of the products that he sells. But if you're going to see a 2% and 3% inflation, why would he want to borrow at 7% or 8%, which even a AAA corporate would be paying for a medium-term loan, to invest in a product whose price goes up by 3%? So what I want to say is that we were in the journey of actually getting inflation back on track, but now the supply side inflation has come in and kind of damaged the story, right? So why I say this point is that you talked about multiple global crises, right? In the previous global crises, there's one more difference, which is about the market. But maybe your question was right now the economy. I'll stop my answer now. When you come to me a question about the markets, I'll take back to the market situation.
Right. So, great answers, sir. Right. Again, so currently, right, as you mentioned, right, there is supply side inflation that could come in, right? India currently imports more than 80% of the crude oil needs, right? And
Yes.
if energy prices remains elevated, and again, this geopolitical tension keeps for maybe a quarter more, right? How serious do you think, right? Not on the energy shortage side, I'm seeing the increase in the prices of energy that India will have, how it will be impact Indian economy. And again, we have seen this in the past also. So are we better prepared? Because the narrative is, right, we have a higher forex reserve, we have a better CAD at this time, right? We were around 0.4, 0.5 times of current account deficit. So, is India better prepared for this situation, or do you see some other risk that might come in?
So again, from an economy perspective, we are definitely better prepared because we have a lot of cushion in the fiscal deficit, also in the terms of the good forex reserves that you mentioned, the prudent policies of the government. I think there's a lot of cushion, but it doesn't mean that it will not be affected, right? So why I'm saying this is in the 91 crisis and all that, we didn't have cushion. So our currency terribly weakened and a lot of damage happened to the economy in those times, right? In 2013, interest rate crisis. So this time we won't have a crisis like that, but definitely I would see that if this sustains for that period, our GDP growth could get shaved off by as much as 1%, right? And while it still will come down to, let's say, between 5.5 to 6%, we will still remain the fastest growing economy in the world and all of that. But it is definitely going to be a shock. Again, how the market will perceive it is or I'll answer that later when we talk about the market. But yes, we are much better cushioned. The impact will not be as great as previous times crisis, but there will be an impact. It's not like we can walk away scot-free. And one more reason for that is that the monsoon predictions so far are of a below long-term average.
Right.
So one of the two things on the Goldilocks side was low imported oil prices and low food prices. But if the monsoon is going to be under its long-term average, then not only oil import and inflation, local food inflation also go up, because remember, in the food inflation, it's not just the monsoon, but the fact that imported crude products like gas are needed in urea manufacture in the fertilizer side. So we are definitely going to see a period of high supply side inflation sustain even after the war, which could have an impact on demand. And so the GDP impact will come in from both the supply side and the demand side.
Right. So again, I think we have covered on the economic part well. So now let's move it to the Indian market side. So again, basically Q4 was not that impacted in the results, so we might not see huge impact coming in Q4 results that this will come in maybe next 15 days. But how do you see basically at a sectoral level or at a market level these kind of the crisis that we have in last couple of months, how it will impact Q1 and next? That are we prepared for it, or you see the market has already absorbed it? Because again, we say market or stock market is a forward looking beast, right? So do we think, right, this thing already priced in, or we think there is still a lot of optimism, valuation is still on the higher side? So how do you look at the situation?
So first of all, I think that what the market has priced in is the March impact of in the current Q4 EPS, right? Market has, if you notice, especially over the last week, 10 days, been increasingly feeling that the crisis is going to end soon. And hence, it has not priced in a further Q1 impact due to this of any significance. Because, yes, 1 month of April, but when you look at a quarter, it has not priced it. So, in that sense, the market is very nervous. And that's the reason you see that when one bellwether company in a sector reports either very good earnings or very bad earnings, the whole sector is getting either rewarded or punished. So we are in that stage where the market is trying to figure out what will be the forward EPS of the Nifty, the mid cap and the small cap for FY 26-27 basis this war and basis the guidance that companies give. But that process is going to get delayed because no company can give a year guidance with a war right on its doorstep. He'll give a visibility for a quarter saying this is my impact. But what's going to happen in the next 3 quarters, it's very hard to expect a company, and the analysts will have to sit and work those numbers on their own. And so the market from a valuation perspective, I would say, will still be uncertain about whether it is cheap or not, okay? Because there is no clarity on the forward EPS. So in the absence of that, you look at trailing EPS and then you say, I'm below my 5-year average, 10-year average. It doesn't matter a whit because like you yourself said, market is a forward-looking beast. And so when you don't have clarity on the forward, you will err on the side of being cautious rather than betting on the future, right? So the market will continue to remain cautious. And when I say market, we all tend to use this word very freely, right? I would say that the market's actions, right, depend on, I would say, probably five different types of players in the market, right? And each
Right.
one will behave differently. Okay. So the five players I would say are, I would put three categories of FIIs. Okay. One DII set and one HNI stroke retail set. Okay. I'm ignoring the what the owners of the businesses do, which over the last 2 years have been booking profits and taking money off the table. But I don't think that will contribute in a very way now. So that's okay. So these three different types of FII. So there's one long-term sovereign wealth fund, pension fund kind of FII, who I believe even through this whole crisis over the last year have been consistent buyers in India. They are not the cause of the problem. So if you take data and segregate it from the buyers and the sellers, right, you'll be surprised to know that the market has been broadly operating on a 40% of the FII volume per day on an average has been buyers. 60% has been sellers. And that net 20% is what you're seeing as the net flow impact, right?
Right.
So what the gross impact is that 40%, these are the long-term FIIs who have already built an India portfolio with a 10-year outlook, who are saying that, okay, there is a correction now, but I don't see the 10-year outlook getting damaged, right? A 10-year outlook may become a 12-year outlook because we will suffer the impact and that may stretch, but they don't mind because their 10-year itself is very long in the distance. So there are these and who are not going to get affected, who will continue buying in an uncertain market because their portfolio is already made and they're only buying more of the same, right? Averaging out their cost. So that's the second is the medium term FII who is overweighting India over the index on the MSCI Emerging Market Index. Now, the MSCI Emerging Market itself has seen a major downside correction. Right? We were at 17% at one time of the emerging market. Today, we are at 13%. Right? So that negativity on India was not driven by the war. It was driven by India's non-AI readiness.
Correct.
Because money flow for an FII, India is just a stock. Taiwan is a stock, Korea is a stock, US is a stock. For him, when he allocates money, he is looking at each stock. And what is saying that those AI-related countries like a Korea and a China are going to grow much faster in an AI world because they are ready and prepared and acting on it. Plus, of course, the US AI companies. But the valuations are still cheaper than India. None of them is trading at this India kind of a valuation. So for them, India is still underweight.
Right.
So they are not even giving us that 13% share that the passive funds allocate to India. They are allocating between 1 to 1.5% less because of the AI. And the war has further damaged this case because of all these countries that I spoke about. We are the one who's importing 80% of oil. We are the one who's the collateral damage in this war. That bystander, झगड़ा रोड में होता है तो कोई आके बीच में उसको थप्पड़ पड़ती है. Neither he was the biker nor the car guy who were fighting. So our situation is we are sitting nothing to do with the war, but the most impacted country in the war. So naturally, an active management FII is underweighting us in addition to AI now on this, right? Now, for him to come back, right? The AI part of it is not going to go away in a hurry. Because even the IT results this quarter, none of the companies has made a very bold and strong statement on the usage of AI. They're all still talking about it in a very, very vague manner, saying we are using this, doing that. But nobody's caught the bull by the horns, and India is still not seen as the AI-ready world. So that money is not going to come back in a hurry. The oil impacted related money that went out can come back to some extent. Okay, that's the second type of FII. The third FII that I want to talk about is your short-term FII, who could be a long-term, but whose tenure has now become short because, let's say, he bought money 5 years ago and has got 3 months to go, right? Because of the uncertainty and because of this short-term outlook. And there are hedge funds which operate on 3 months and 6 months outlooks, right? Also, because that's the nature of the beast. For them, India is a sell currently because of the impact of the oil and the impact on the currency. Because for them, currency adds or subtracts from their returns massively. India as a country is baked in a 3 to 4% or 2 to 3% depreciation in their calculations. But over the last year, the Indian rupee has been the most worst performing currency. So their portfolios are underwater because of the currency. Forget about the stock part of it, right? And so they are exiting because they don't see the currency. The RBI brought in some measures to strengthen the rupee when it last went about 94 through administrative actions, acting on the banks, acting on speculative trading by the prop books of the banks. But that effort has already gone away. Rupee has again breached 94. There's a limit to which RBI, and RBI doesn't target a rupee rate, remember. So today the forward premium market, if you look at it for 1 year, it's showing the rupee at 97.50. Okay,
Right.
so what I'm trying to say is that a short-term FII is still in a sell India mode because of the currency and because uncertainty around the war. And in the short run, this set of hedge fund FIIs also has got one more weapon in their armor, which is negative for us, which is shorting the market. So not only are they pulling money from the cash market out, they are using the F&O market to short India. So if you look at the long short ratio yesterday was 18 to 82. The put call ratio was at 72, which means the very bearish trend. So what I'm trying to say is, so all of this are the impact. So this, however, if the war goes away, this set of short term is likely to turn around quickly. Because for them, then if they see the oil impact goes away, the rupee can strengthen in the short run, they will actually take long bets on India as opposed to shorting India, right?
Right.
So this is the set of 4 FIIs. So from the way I'm saying from a market perspective is, so now comes to the DII. Now the DII, right, what he did last month when the war happened, they actually went out in the front foot. Like it was some power play in the T20. FIs sold 1.2 lakh crore. These guys bought 1.45 lakh crore. They used all their cash and their reserves. They're getting what, 30,000, 40,000 crores a month the mutual funds are getting, right? But they went and spent 1.5 lakh crores and drew down their cash balances to defend a market, but they were catching a falling knife. The more they defended, the more market was also correcting. So all their actions did not help in this short-term correction. So beginning of April, for the first 2-3 days, they brought in 8,000-9,000 crores. But after that, it petered out. Because when an earnings season comes, in the first quarter, the first few days of the quarter, they build up cash balance so that they have the money to buy the right sectors and stocks based on the earnings.
Right.
So you saw them going through that profit booking phase. And yesterday, finally, they bought about 4,000 crores, which was a big jump up from what they've been doing in the last day. So where I'm coming from is these DII money, right, has already been deployed in the market. Now, incrementally, the DII money will only do sector rotation. It cannot take the market up on its own stand because it doesn't have that much money, because they've already used up a lot in the last month. So this 40,000 crores of mutual fund flows, maybe insurance and provident fund and LIC with a little bit, maybe you can say that their buying capacity may be about 75,000-80,000 crores a month. But if FIs sell, as yesterday they sold 9,000 crores, that's 20 working days, that's 1.8 lakh crores. The massive DII amount, if they put, they can only meet half of the FI sale, right? And plus, entire DI money is not available to buy what the FIs are selling, because FIs are selling in the top 150 stocks in the country. DIs get money in the full market cap range of the country. So they can't take a small cap money and buy large cap beyond 35% in a small cap fund. So it is going to be a pretty dicey in terms of the fact that as the earnings season progresses and they make up their minds about which sector will give a good EPS for FY 26-27 and make a buy, they'll have to sell something to buy something. So there's going to be a huge amount of sector rotation. And finally, the last bit in the player is the retail and HNI. Now, over the last 1 week, because of the ceasefire news, these guys have been feeling that, the market has overcorrected and have rushed it. And as they say, fools rush in where angels fear to tread. So they have massive amount of buying, but yesterday and day before yesterday, the correction, again, the short-term trader kind of people might have booked profit also. But otherwise, those who put their lump sum in are going to face the pressure. I don't know whether they can sustain the buying in the coming weeks. So why I'm saying, I'm sorry to give a very detailed answer, but to tell you that the markets bounce back, right, in terms of absolute level is not going to be easy. There are a lot of things that need to change and you need to demonstrate that to do that. So market is going to be in a consolidation phase for a fairly long period of time, even post the war ending, right, until all the clarity. So maybe a Q1 result, the guidance from a Q1 result. So which I'm saying July 10th, hopefully the war would have ended and the companies will have a clarity on their next 9 months of the year. right? They
Right.
can talk with some confidence. Today, how will they do? They don't know whether oil price is going to sustain at this 105 for another month or 2 months. So his hisab say he can give a guidance for the future. So we are
Right.
in that kind of a nervous space. And one final point in terms of the market, I'll tell you, the reason I am saying that it's going to be tough for the FIS to come back is because in typically previous crisis, you might have been wanting to ask this question, but I'll take it on and answer it now. The previous crisis, the way we bounced back versus this crisis, the big difference is that in the previous crisis, we didn't have strong DII support in the run up to the crisis. So we corrected a lot. Okay. So
Right.
when we corrected a lot, we entered the value zone fairly quickly, whether it was a COVID crisis or a GFC crisis or a currency crisis of the 2013 interest rate crisis. We bounced very sharply down, and so the bounce back made us very attractive for FIs to come. But this time around, we have had a massive DII support to the market. The market has not corrected to the extent that the FII wanted it to correct. So today also valuations of the Nifty are still at 2021. The valuations of mid cap are at high 30s. Mid cap or small cap is in the mid 30s. So you're nowhere near a value zone yet. Okay, unless the forward earnings comes and shows a strong improvement in the EPS, and then you compare with the long-term rate. Second, it's a relative valuation. Every market around the world has corrected. So it's not that our correction has been, in fact, similar, was slightly less than the correction in other emerging markets. So we are still at, last I saw, 52% premium to the emerging market PE. Okay. Our long-term average is 64%. So there's one school of thought saying, oh, we are below our long-term average premium. People forget that at the end of the day, you're still at a premium. And how do you justify your premium? You've never beaten a discount. That you should accept. Our lowest premium was at 30% premium. Okay. So to be fair, we've always been a premium country. There's never that we've been at a discount to the emerging market PE. Okay, fine. But I would still say from an FI perspective, we're still not entered a value zone where he can step in and buy us because of the value in our market. As we all know, the Chinese market is trading at half our PE, right? The Korea and the Taiwan. So to that extent, I would say that, the DIIs, while they have done good by whatever protect, you said 18 months investors not made money. If the DII flow is not there, investors have lost 15-20% in the last 18 months, which they have not done, right? So I know it's hard to tell an investor that, oh no, you could have lost more, but you have not lost that much. But that's the reality of it, right? The DIs have actually cushioned the level of the fall right through the last 2-3 years, and hence the rise also cannot be that sharp. You understand? Because the
Right.
fall, the harder you fall, the sharper the bounce back, right? So to that extent, I think it's a time for patience. And finally, since you mentioned that 18-month period, actually till September, right? If you see, September 24 was when FIS started to sell India.
Yeah. Right.
Until September 24, they were buying India. So the levels of the market were high. And so from September 24 to September 26, the 2-year period is going to be a challenge because the base is very high. But
Right.
post September, to whoever is panicking, reacting to this, saying my returns are not good, just hang on till September, after which automatically your returns will start to good look better because the market has started correcting and your base is going to go down and your returns will start looking up. So just the period till September, purely from a base effect period, you just got to be a bit patient.
Right. Beautifully explained, sir. Right. Again, a lot of people have the question, right? Suppose like a lot of people have started comparing it with the COVID-like scenario, right? But you have explained it beautifully, right? Larger the fall, higher the rally kind of story. But we have not fallen that much in this crisis. And one thing that you mentioned is DII support has been in because SIP flows were enormous. But sir, there is one more school of thought that comes in the mind is like how patient these retail investors are. Are you sensing people have changed materialistically in their emotional behavior that even after seeing their 2-year or maybe 3-year returns flat or lower than FD, will they continue the strong SIP momentum? Like, as you come from this background also, can you emphasize on whether this has changed structurally or it just we need to see whether this huge SIP flows is structural or not?
So it's a mix of things there. So first is that last month the SIP book went up by 2,000 crores,
Right.
right? So that one indicates that even in the worst crisis month, right, SIP flows increased, right?
Increased. Yeah.
That's number one factor, which is a comforting factor on investor behavior. Second is, however, there is one more factor, that the number of cancellations was more than the number of new entrants. Also there. So what it means is also is that obviously some part of it would have been just maturities, because it's not just cancellations. It is SIPs which went out. So there's a normal maturity. If somebody put a 3-year SIP, it matured, naturally it goes out of the system. So we don't have the breakup of the data or how many people prematurely close their SIP with this. But I think it's more or less, it's mostly a maturity, I would say, because since COVID now, it's about 5 years. So many people have started a 5-year SIP, and would have naturally that would have matured and that's gone close. So I'm not going to read too much into that. The third aspect here is that in the previous crises, whether it was 2019-20 pre-COVID or the 2007-8, there was a massive marketing engine of the mutual fund industry, which had brought in a lot of lump sum flows in that period. If you remember second half of 2007, or even, so that lump sum, when it gets corrected, right, people tended to leave the thing. In the case of COVID, luckily, the bounce back happened so sharply that people didn't have time to react to redeem. So they got protected. But in 2007-8, we saw that it took a long time for the retail investor to come back, right? So why I'm saying this is, however, this time around, it has not been a lump sum story. It has been the SIP story. So what I'm trying to say, when you are rising, if the markets were risen, right, from let's say September 2024, or whatever reason, let's assume that FIs didn't exist, and the market was rising, and today the market has fallen. A person who's put a lump sum in September 24, right, if the market was actually rising, would have lost out because of his SIP, because he averaged out his money over that period in a rising market. But this time, the averaging has been happening on a falling market. So compared to a lump sum investor who put in September 24, the SIP investor who started SIP, his feeling will be much better because you bought on the down right through the period. So the pain is got pushed down, right? And if by September the recovery happens, then we would have passed this phase. So SIP is one of the reasons why the maturity of the investor is better today, because his money has come in staggered amounts, right? So the pain is not as bad as a huge lump sum investor had made in September 24. Third is the composition of the investing population. Now, yes, it is true that a lot of these are new investors compared to earlier, because from 3 crore investors in COVID time, we have gone to almost 6 crore unique PANs now. So a lot of this is new investors. And so many people are saying that, oh, they are new investors, they have not seen a bad market, they have not seen a bad cycle, they are likely to panic. My perception is different, because these new investors are younger investors. And if you see the penetration of demat accounts and direct equity and F&O, these are willing to take more risk. So I think that mentally the demographic thing is a younger population here is much more aware of the world and much more aware of what is happening. And hence, I feel that they have a higher risk tolerance than the set of investors there during previous crisis. So in my view, we are unlikely to see, in fact, it was not just the SIP book which went up. Lump sum figure went up by 33%, from 30,000 crores in February to 40,000 crores in March. So you can see that there's a younger population actually looking at the correction as a buying opportunity and actually stepping in to average out, which you saw also as over the last week also. It was if you see the advance decline ratios, right, over the last week, there have been 2:1 in favor of advances, except for the last 2 days, the market corrected when it was reversed in favor of declines. So which means what? And the smaller cap, micro cap indices have been outperforming the large cap. So there's huge retail HNI buying happening during this correction when they feel that the war is likely to end. A ceasefire announcement came in. So I think I wouldn't call this maturity. I will hesitate to say maturity. I will say the risk tolerance is higher. See, because maturity is a different thing. I don't think they are more mature because they don't have the experience to be more mature. But because they are much more internet savvy, much more aware of what's happening in the world, much more aware that conflicts don't last forever, much more aware that there's a mauka hai, so willing to take that shot. So today that investor, I would say, is a less panicky investor, but not necessarily more mature. Maturity happens only when you go through a bad cycle and a good cycle together in one phase, which is not yet happened for these investors. But they are definitely much more, I would say, aggressive in their risk appetite. And hence, they are unlikely to panic as much in the current.
Right, right. I would request Vipulji to, can you please mute off because it is, yeah, thank you so much. So, Sunil sir, again, you have explained it again beautifully because it's basically not maturity, it is basically the more acceptance of more risk, which basically comes from what we think and what we have. Again, we have been engaging with a lot of retailers, but what things come is the return expectation post COVID has been much higher. And they have seen this in last 4 or 5 years. They can make someone north of 20% or on the higher side of 20 or 18, 19% at least. So are these dreams being sold off to them? Because some of the guys believe in that philosophy also. That again, even if you keep on doing SIP, you may not make money. So how do you basically communicate this to most of the retail investors that okay, things will be good, maybe 2, 3 years down the line. Maybe you need to temper your return expectation, but still you will get much higher than what you can get in FDs or other source of investment that you might do.
So I think the answer to that lies in the fact that you go back to what Mr. Warren Buffett used to say, right? That he buys businesses, not stocks, right? So to translate that into Indian terms to a retail investor investing, right? For just think of India as a stock. You're buying the India business, not the India stock, which means what? You're actually buying the India economy and not the India market cap, right? Because the equivalent of the stock price is the market cap for a country. The equivalent of the EPS growth is the GDP growth of the country, right? So when you think in the long run, it is the business which delivers value, not the price. So if you go then through Warren Buffett's own journey, he's bought many stocks at a very high PE ratio, right? Whereas he sold many which are at a very low PE ratio. Because his fundamental thing is not about what the market is treating that stock today. He effectively didn't care. So he didn't invest in the dot-com bubble and he lost money during the dot-com bubble because he believed that this market is just overrating it, but the fundamental business doesn't have that earning capacity. So the point is, India as a business, Indian economy as a business, there's no one who's questioning the long-term growth path of the country. Yes, in the short run, there could be a 1% GDP correction for FY 26-27. But nobody is saying that FY 27-28, we will still be at that low rate, right? And the reason for that is the sheer number of people that we have who are young. The demographic dividend, as they call it, is because this is ultimately any government in power has to provide jobs. I know AI is a big threat to the job scenario. We will talk about that later. But it is a fact that with so many mouths to be fed and those mouths have to be given jobs, the country will find a way. It's a sheer pressure of it. The political system has to find a way. How and where and what, don't need to worry. The fact is that there's no other country who has such a younger population, no other country, just for a statistic, I'll tell you, over the next 20 years, 2025 to 2045, India is going to add 15 crore people to the workforce, right? And China, which is the main other population engine, is going to lose 11 crore people from the workforce. And the next highest who's adding is Indonesia with 1.6 crore. So I'm saying Zameen Asman ka farak hai. So what I'm trying to say is, I can't tell you today ki solution kahan se aayega. People will say, AI se jobs nikal rahe hain, ye kahan se job. Think about it the other way. If jobs are not provided, then our country is going to be in a deep problem. And obviously, we will not allow that to happen. We will jugad our way somewhere to make sure that now China is going to replace this with robotics and AI, right? This workforce, and by transferring some of its work to Vietnam and other friendly countries. I believe that ultimately India and China will start to work together, leaving the Galwan related issues aside, because we are ideal partners, because an aging population with the technology, right? And a young population which can take over a lot of the labor-oriented work from China, and India-China as a partnership, we will go. I know today it looks very difficult, we are still fighting, but no, you look at it as a 10-year story. I'm just saying this driving force means that India's growth rate, India is going to be contributing something like 19% of world's GDP growth over the next 2 decades. So the point is, you're buying India when you invest in the stock market. Don't worry about the valuation of the stock market. Don't worry about what the market cap is, right? It's not relevant at all. It is the fact that this economic engine of the growth will ultimately deliver value. Now, what that value is hard to say. I can't say that nominal GDP is one way to say that over the long period of time, markets have always delivered better than nominal GDP, right? And I believe that a 4 to 5% inflation and a 7 to 8% GDP growth for the rest of this decade and the next decade, we should step it up to 8 to 10% GDP growth. So a double-digit return is definitely in the realm of the possibility, right? Now assume the lowest double-digit return of 10%, right? I don't see a day that a fixed deposit is going to give you 10% and the bank and the market also gives you 10%. Even if that does happen, the taxation benefit of it will make this a much better return to you because you're comparing 12.5% taxation versus 30% taxation. But I'm just saying, I don't see if Indian deposits are going to be giving 10%, that means the lending rate in the economy is going to be at 15, 16%, which means the stock market itself will deliver a much better return from all the profits accruing. So what I'm trying to say is that at any day, from a medium-term perspective, the stock market is a much better bet than a fixed deposit for, and the mutual fund industry has a range of risk-reward options for you to consider. For example, hybrid products are somewhere in between, right? Between FD and this in terms of managing the risk reward. Yes, you will give up some return for getting more risk. So depending on your risk appetite, you can choose a number of alternatives in the industry. But I believe that the bottom line, that apart from pure debt products, any other product in the industry is going to deliver a double-digit return over the next 10, 15, 20 years, right? So I don't think that whether that will be 20% per annum for 20 years, I think it's unrealistic to expect that because 20% type of valuation returns happen only in two scenarios where A, there is a deep correction and a bounce back as it happened post-COVID, or two, when the growth exceeds the expected growth rates. Let's say India is to grow at 6, we deliver 8. We expect to grow at 8, we deliver 10. We expect to go 10, we deliver 12, 13. Unless the economy surprises the market, you will not get that 20% sustainably. It can happen in short bursts of time for short periods of time. But on a sustainable basis, to say that over the next 15, 20 years, I can get 20% RM, first, you should disabuse anybody of that notion. The market is not a money generating machine. The market is, right? So I think double-digit returns over the medium term is a safe from the hybrid plus equity product suite, I think.
Right. Beautifully explained. So now let's shift gears towards a topic that I think it's talk of the town now, right? So impact of artificial intelligence on Indian IT sector, if I say about it. And again, Indian IT sector has been built on services, manpower, arbitrage, and the execution like, of these things that maybe US guy cannot do it and Indian guy can do it more efficiently at a much lower cost. But now AI threatens these kind of by automating significant portion of what India as a country in the services part used to do it. Right? So how do you think about it? Our Indian IT sector is the existentialist. I'm exaggerating that, but just to put into the context, right? Is it an existential threat or Indian IT will find a way to cater to this demand some way or other and it will continue? So how do you think about this?
So, two parts to my answer. Yes, it is an existential threat to the existing business model of IT companies. Right? 5 years from now, 10 years from now, companies which are running on today's business model will be hammered in the stock market, will sell at 10% of their current stock price.
Okay.
Because the existing business model, and it's and the reason for that, I'll go into it in a bit of more detail, right? The reason for that is that the customer is becoming aware of AI, and so he is going to push the IT companies to say, you can't charge me per hour or per manpower. Okay?
Okay.
So from that point of view, their business model is definitely under threat. No doubt about it. The billing hours per this is history. It may not die immediately, but over the next 2 years, it will die a slow death. Okay? Now, where will it still have some bit of survival in that old business model is in very small companies, which think that the cost of implementing AI is too expensive, and so they don't have a bargaining power with the IT companies. But the Fortune 500 companies will all talk AI to the IT companies, okay, and tell them, look, there's AI coming in, right? So you quote me a cost for the project. Don't quote me a cost saying it will be $300 per hour or $300 per employee or something like that. They will not allow that pricing model to survive, right? And what they will do is they will show the threat that using an Anthropic, I can install this in my desktop and do it myself. They will never do it because it's not easy to implement AI. But I'm just saying it's like a threat they will throw. Okay.
Yeah.
And some one or two companies may actually experiment, fail, and come back to IT companies. Okay. Because it's easier said than done in terms of implementing AI as a user industry. Okay. So that's the point. So yes, there is an exception there too. But is that an exception for the IT industry? No. Why? Because the IT industry will need to adapt to the new IT world. So the IT companies will be very different 10 years from now to what they are today. What will they be? They will be AI consultants. They will be going and telling a company that I will help you implement AI and help you to reduce your workforce. Correct? So they will actually go to the user. The impact of AI is going to be on the user industries. The faster Indian IT companies have three use cases for AI. Okay. So first is, I'm writing in the from the low to high degree of importance and impact. The first is to use AI for their internal operations, their own back office, their own work. They will have to put it on AI because that is the way you learn AI. That's the way you implement it. So there are going to be layoffs from their back office over the next. Okay, that's number one. Number two is to take the AI tools and package it as a part of their current offering, which is what they're already doing to a user company. They will use AI internally to reduce the cost of their operations. Of course, laying off people, but they will still make a good margin because they have used AI in a very smart way, which that user company doesn't know. They will naturally change to the model from billing per hour to billing per project. But in that billing per project, their margins could actually widen because they have cut a huge degree of the workforce, and that guy doesn't have a clue on your workforce. You're no longer billing him on a workforce. So you will lay off massive amounts of people, but you will provide the same service on a per project cost, but with a much higher margin. That's the second layer of AI. The third layer of AI is to do what I said, is to go to these companies and say, hey, you're giving me your IT related work, right? But in your sales operation, in your back-end operation, your regular work, I can bring AI to you and reduce and help you to lay off 50% of your workforce there by coming and making you AI ready. That's a huge, huge opportunity. But for that, these IT companies have to build the skill set. You have to build that, and you have to compete with the Accentures of the world who are going to be doing the same thing. Right? And you got to, and the AI companies, the valuations of the AI companies today, initially I was also thinking that these guys have huge cash balances, that you go and buy an AI company and fast track it. But then I realized that the valuations of those AI companies are quite crazy. Google is going to invest $40 billion in Anthropic, man. These guys, I mean, so I'm just saying that now is, I think they can't go and buy an AI company. The valuations are quite crazy, but they have to partner. Like Infosys announced the partnership with Anthropic. So you have to do partnerships, you have to do that, but these are the three layers. So what I'm saying is the companies which adapt this and grow will actually be fabulous wealth creators. But the problem is today we don't know who, and even in the latest quarter's earnings season, so far, I haven't got a clue on who is ready to do this and being very bold about it. They're still hesitating to use they say, no, in normal language, you don't use the F word. Like that, they are hesitating to use the A word, AI word, right? They are still skirting around. They're saying, oh, we are doing AI and this, we are doing that, that. But you have to take the bull by the horns and do it. It will happen. Definitely, there will be quite a few Indian IT companies which will uh, do this and survive. But to sit today and say, pick the winner,
Hmm.
I can't say today. You have to constantly study the IT companies, what they're doing, engage with them, which is what I suspect all the FII analysts, when they engage with an Infosys and a Big Pro, they will be talking these questions and not just this. And what worries me is that after each of these results, the stocks are getting punished, which means the FIs are not convinced with the answers being given by these companies. The massive correction yesterday, though Infosys didn't report such a bad result, but it sell off the whole IT sector by 5% in one day, which means
Hmm.
what? Those FIs who went to the analyst con call, the questions they asked, they did not get satisfactory answers. So my worry is that in the short term, the PR of the IIT companies is not up to mark. They are not talking the right things to the analysts and telling them to tell them that we are ready in this AI world, right? We will get ready. So hopefully they will learn that over the next quarter and do it. But until that, IT stocks are going to be under pressure because FIs are significant holders of these companies, right? And it's a 14% of your index, large cap index. So naturally, even a passive fund holds that much. So the point is, why I wanted to say is that, so, but at the same time, from a stock market perspective, right? I don't think you need to go and sell IT stocks. Okay. And I'll tell you why. Because one is that the valuations have significantly corrected. And I believe they've corrected a little more than they were due because it's like the apocalypse is happening now. Right.
Hmm.
So that the business models of these will die a slow death. So over the next 2 3 years, they will have sustainable revenue. They're not like, but you know, the way discounted cash flow works after 5 years, it's a tukka. For the rest of the millennium, this company
Yes,
will have a steady state earnings. That is what has been
exactly.
collapsed in all the models. So it's assuming that these companies have no business after 5 years, which is not the truth, right? So the correction has been overdone. That's number one. Number two is these companies, since they are not able to find real good buys at the from the cash flow, will continue to be decent dividend payers. And because of that dividend payout, you will get a new set of investors from pension funds to else who are income seeking investors for whom the stable business model and the fact that Indian currency is weakening means though on a constant currency basis they are not great, but the rupee devaluation means whether it's an Indian investor, you will get that 3 to 4% depreciation as a return because the EPS will carry that rupee growth. And for the
Right.
foreigner also, hedging against the weakening rupee, IT is a decent bet for him. So there will be a set of income seeking value investors. So the final point I want to make is that as a market, as a IT share marketplace, right? IT has been through the reason for the steep correction. One as I said, is that after 5 years, they're talking about a big fall off in the earnings of the company, which is not correct. But the second aspect is pre-COVID, post-COVID, post-AI. If you see these three periods, right? Pre-COVID in IT was a steady, stable, regular growth, sustainable growth, very clear in that, and it had carried the valuations that is due. In COVID, suddenly this Internet of Things, work from home, yeah, falana, falana, IT became a growth sector. So from a fairly reasonably priced steady state growth, more like a super utility company, it suddenly became this huge growth engine. Everybody thought companies are going to go and transform Internet of Things, IT will be at the core. So it became a growth. So the post-COVID phase, the fantastic rally by valuation expansion. If you just take a history of their earnings growth pre-COVID and post-COVID, there's no big difference.
Right.
The growth came from a valuation expansion post-COVID, right? And now the market is just punishing that valuation expansion and it's taking back to its pre-COVID level of status. So what is happening is that a lot of funds and fund managers and everywhere, international, domestic, had IT as a part of their growth pack. And every fund house, every fund, even a small cap fund, has a value component and a growth component, right? IT had become a part of the growth component. Over the last few months, maybe, and over the next few months, it will be shifting into the value component of the portfolio, right? So there will be a churn because a value fund will actually want to increase its IT exposure, but a growth fund will want to reduce it because its component of value and growth will be different. So there is going to
Right.
be a lot of churn, but there will be buying support by value investors who say itna correct ho gaya, now there is value for me. So apart from your income seeking pension funds from outside India, even within India, value seeking investors will continue to buy and support it. LIC will, for example, be a very big supporter, I believe, in this context because of the value. And for retail investors, then I would say you need to change the mindset in your, if you have an IT sector fund or individual IT stocks, please do a reassessment of what is your growth component and value component. And somebody comes to tell me, no, I'm only growth. Then you're in a high risk, high reward play, boss. Every investor, in some degree, based on whether it's conservative, moderate, aggressive, should have a value and a growth trade-off in his portfolio. The aggressive guy can have a majority, but IT now forms a part of the value part of your portfolio. So decide for yourself that IT sector fund, if it is there as a growth component, reassess it. See what is it? Does it fit into the value framework? Then I'm saying IT as a value play still has roles to run. Okay. And my final point here is, I know we generally talk about medium-term and long-term investors, but I believe that while we keep telling our investors that you should be long-term, medium-term, customers are human beings. Customers have fear and emotion and greed, right? So everybody wants, there is some amount of tactical play that people do, even with mutual funds, with sector funds, and with stocks, right? So IT has a very good tactical play component. So if you are of that type, right, I would say that IT represents an opportunity for tactically entering and exiting based on expected currency movements, how the this play out, but it needs smart tactical play. It's not for the ordinary investor who's a long-term investor, forget it. But if you're a, I wouldn't say smart investor, but if you are a aggressive risk-taking type who doesn't mind taking short-term calls, right? IT will represent a wonderful opportunity to take short-term calls, because even within this AI framework, prior to the war, prior to this earnings season, IT actually went through a bump up, if you saw. Right?
Yes.
So
Right.
go through those phases. So if you are in that kind of a space, right, there will be tactical opportunities to make money of IT, right? But like I said, that needs a lot of skill, a lot of will, and a lot of courage. But I will say that there is one segment of investors. Why I point this out is that there are people who are going to be doing that.
Right.
So you can take advantage of that, but it's hard to give advice to that. Let me tell you that very clearly. But you will see that that component of play, people who will come and trade in IT will also go up because of all the factors that I said. People who feel this is overdone, people who feel this, they will step in and say, नहीं यार इतना correct हो गया तो bounce होगा तो short term के लिए ले लेते हैं. So that kind of a thinking will also come, and which will also make the IT prices a little volatile. So my point of view was stating that in that volatility, right, it's a good part to play. So I would say that even as a value investor, you feel this IT is worth a pick, you do it SIP staggered. Right? Don't try to do a lump sum. So it's my final point on IT. I hope I did covered everything that you wanted me to
Yeah,
do.
again, excellently covered, right? Because that's the fair understanding that we need to think from both the side. That's the advantage, right? Like again, this experience teaches you, right? Everything goes in cycle. So it moved from grow value to grow, then again it's coming to value, right? That's the interesting bit. So with that, I will open the forum for questions. Guys, please, if you have any questions for Sunil sir, please write in comments so that I can choose. Yeah. So till that time, sir, again, one thing that always kept in mind is two things that FII zone was IT sector, and second was Indian banking as a space with all the large private banks. So have we seen the selling part, right? Both the sectors have not done well since 2021 or maybe 2022. So Indian private banks has also not given anything, and their price to book maybe that used to trade at around 3, 3.5. I'm talking about HDFC quota get much higher. It has come down to 2 times price to book. Right? So do you see some opportunity in private banking space as such, or you think it's PSU banks are catching up, so there will be a lot of competition for good customers? So
See, I'll tell you
yeah.
what. See, FIs have been selling the Indian banks for two, three reasons. Okay. So first is that the HDFC Kand has given a big damage to the reputation of the Indian banking industry itself. The way that was handled, the PR, I know that there was no really big loss or any such thing, but the way the chairman resigned and the way the regulator stepped in to clear the air, and but the company itself and this thing did not give any good clarity, so it left a bad taste. Let's first address that issue. That post that itself, there has been a, not just for HDFC Bank. I can't talk stock specific. I'm just saying that for the whole banking, from a FI perspective, it's caused damage to their view of the Indian banking sector, because they said, how can the chairman have a disconnect and the board not aware and do, and then 2 days after he resigns, you go and sack the entire team which was involved in that entire 81 bond issue. So that it was corporate governance and everything. There's a question mark. Now, there's no doubt that it's a good bank and everything fine, nothing wrong. But the fact that there was some misselling at some arm of the bank and the bank didn't take action, it's not then squeaky clean from it. So let's admit that that has been a big damaging factor for the Indian banking itself as a part of that. Second aspect is that the sell-off has happened because of the fact that when an active fund manager and a passive fund manager, right, you are betting 35% is on banking already. So when you're then selling India because of oil, you're not going and picking stocks. A fund manager has a limited ability to go and buy individual stocks. He sells India. So when you sell India, 35% is banking. So it's just that in sell India story playing out because it's the largest weight. Okay. The sheer impact of that is showing up. Okay. That's point number 2. Point number 3 is the fact that most of the Indian banks, a little less in private sector, but large in public sector, have always held far more government securities than required. So when this whole thing translated into G-Secs going up to 7% levels and all, there was this thing that their mark-to-market is going to take a hit because of those treasury profits, right? So short-term, tactically, they said, these are going to get hit. Now, I believe that's a problem which will get solved because credit growth is rising faster than deposit growth. So these banks can't afford to keep much more than their SLR requirement, which they have to anyway keep much more than that, right? So that will get corrected out, right? Because the credit growth is going very strongly, right? So the issue is that as far as the private sector banks and public sector banks, despite the massive rally of the public sector banks over the last 2 years, right? There is still a price to book gap between a private bank and a public sector bank. So the gap was so huge that even this big difference in the performance of the public sector bank pack is still there a discount to the private sector bank, especially on a price to book when you look at it. Okay, that's one. Second aspect is that the deposit mobilization related pressures are far less on the PSU banks than on the private sector banks because of the rural branch spread that the PSU banks have. The significant amount of government deposit they still manage and handle. The private sector is making a dent there. And the third aspect is that in the lending part, in the medium term, right, the private capex revival story is the big story to be played in India. And that story involves a lot of SME and MSME financing, which is the fiefdom of the PSU banks. None of the private banks has the guts and the thing to go. It's essentially name lending. It's knowing the person. It's, doing that, which private sector, public sector banks have been doing. They've been through their worst NPA cycles because of this exposure, but there's been a lot of learning and a lot of professionalism. So when the capex, because PSU banks will be leading at the lending part of it. So their loan growth over the medium term will be far fast riser. That's why PSU banks are a medium term better bet. That being said, right, this summer is a big test. Because the GST cut which played out in auto last year didn't play out in the consumer durables yet. But in the summer with cooling related durables and all that, if the consumer durable story picks up in the summer, because people are still not affected by the war or this in terms of their purchasing behavior, right? And rural incomes also, because food prices are strong, which is bad for inflation, but good for rural incomes, right?
Right.
Means that EMI-based purchasing will step up, which is the fiefdom of the private banks and the NBFCs. Public sector banks are nowhere in the picture. So in the short run, the loan growth book of the participating bank should be good. NPA quality numbers are still looking excellent for both PSU and private banks. No issues there. So overall, I would say is that the situation is that private sector banks will do well only when India risk comes down for FII money to return. Okay, because they have that, because it's there in the India book. But DIS, I believe, will prefer public sector banks increasingly as a play because of they're building on the India growth story still, and for their public sector banks still, I believe, are there. Though in this quarter, I'm seeing a lot of profit booking happening in the PSU bank space by DIS, because that's where they made money. And that's why they want to raise the cash so that they're ready for the next wave. But once the earning season gets over, I'm sure that they will get back into. So basically, to cut my answer short, right? In the short run, private sector banks, loan growth book and numbers, everything should look good. The earnings should look good. But whether the share price will go up depends on the FII outlook on India on a post-war scenario. But public sector banks, I believe, in the medium term will deliver better results. And there is still a valuation catch-up to be done between PSU and private. So they are a better bet from a medium-term perspective, right? From an ownership perspective. The other good wave which is happening to public sector banks, I believe, is that the government sooner or later has to merge the top PSU banks to get them up to international scale. Right? It may, because of the challenges now in this and that, the elections and all, they were hesitating to do because. But I think this time it's not about a bad bank being merged with a good bank to bail out the bad bank. It's about good banks being merged to get scale. When that happens, that will immensely improve their fundraising capabilities from international markets and all of that. So again, that's a point in favor of a public sector bank from a medium-term perspective. This is not a short-term thing; it's a medium-term thing. And one final point is that I don't know how much of this is a concern, but it's there in the news, and I just want to mention it. But I have no evidence that it's actually played a part in the way FIs have reacted to the private sector bank. It is the number of frauds which are happening in the private sector banks, which are popping up now and then in different places. So that again doesn't give them a comfort about the private sector banks in terms of their systems, risk management, processes. It's just, I would say, a cloud, It is not pinpointed that this, but they're seeing that it's happening in a number of banks, right? So from a comfort perspective, a foreigner always looks at India with the jaundiced eye. He doesn't trust. And one of the reasons, in fact, for IT to have been a darling for them is because any IT numbers, he can always cross-check with the buying company, the Fortune 500 company in the US. So he has no doubt that the earnings company is because he's cross-checking it there. But about the emerging market, it's not just India, okay? It's just about the emerging market itself. They believe, like IMF also gave a C grade rating to our accounting or to our GDP accounting numbers. So they are always carry a little bit of a doubt and a suspicion. And so these kind of things, they don't help. I will not say that they're causing hurt, but these kind of frauds which are happening in mid-sized private sector banks here, there, other, chota mota, is giving them saying, are there is really good risk management practices? Could these have been prevented? What's with the Indian banking system? But RBI has done a fantastic job of doing a good PR and giving a very good communication. They have a lot of confidence in RBI. You have to admit. But still, I would say that there is, I don't know what percentage you attribute, but some degree of, I would say, doubt is a very strong word. Little bit of a thing about the Indian banking, private sector banking system is definitely there because of the negative news headlines around these frauds. So you can't wish it away. It is there. You can't do anything about it. It is there. And as a foreigner sitting in America, thousands of miles away, somebody, and you don't have any shortage of enemies, right? Somebody will point out some report saying they get 3-4 bank yes away to the foreigner, they will think. So it's not a big enough point, but it adds a little more to the whole negativity which is there in terms of that. But bottom line, an FII return is important for a sharp uptick in the private sector banks. That much is very clear.
Thank you so much, sir. So let's take few questions from the audience. So Deepak Juneja ji is asking, do you expect interest rate to rise due to increase in supply side inflation?
Absolutely. RBI may not hike rates, but the market will hike rates. the gap between the deposit mobilization and the credit growth is widening, and people are even now putting more money in mutual funds compared to bank deposits. So banks have to hike deposit rates, and lending rates will also rise, because when your credit deposit ratio is going the other way, incremental credit deposit rate is 90% or something. Okay,
Yeah.
so definitely interest rates in the real economy will go up. Whether RBI rates cuts or not is irrelevant.
Okay. Right. So which sectors do you feel whether this period of uncertainty will, in your opinion? Okay. So basically, the question is, which sector do you feel one should bet on, or maybe will remain away from this kind of crisis going on? Would
Zero.
be none, right? Yeah.
None. And it's not the right time to take a sector call. I'll be happy to answer this question when the earnings season is over and I've got a sense of the guidance. But even that, I'm only about 75% sure, because I'm not sure these guys will give any confident guidance itself. So I think that it's very hard to take a. I mean, why I'm saying the start of the war, you ask somebody, they say, banking safe, yaar, it doesn't affected by oil prices. But the worst performing sector is the banking sector in the war. So you can't, I'm saying sectoral call, this is not the time to do it, boss. In the middle of a
Yeah.
geopolitical crisis, right? In the middle of an earnings season, right? You can't go and take a sector call, right? It's not, it's not appropriate. That's what I would say. I have my views, but I'm hesitant to share those views because things could get worse before they get better.
Right.
So I'm hesitant to say that in a public forum, and then people say, "अरे यार इन्होंने ऐसा कहा था अगले हफ्ते और 5% गिर गया ये." So the chance of getting called out like that. So I do have my views on which medium-term sectors to take a call on, but like I said, it's not the time for investing based on sector calls. I have
Right.
sector calls, but even I am not personally putting money massively behind those sector calls. I'll keep tracking them, and if my thought processes turn out right, then I will incrementally add. But not now that to say that yes, sector is war proof, and regardless of
Right, right. I think no one will say about these things because we have seen pharma crashing in a recession kind of way, which is called a recession-proof sector. But FMCG, no growth, no returns. Right? So again, but if I take the spirit of the question, right, which the user had sent, right? So again, a full disclosure, nothing is a buy or sell recommendation. We are a SEBI registered entity, so we do not guide you on stock level things. But the goal here is we search so basically which sector one should start reading more about, maybe from next 3 to 5 years kind of perspective. Do you think manufacturing could be that one? Capital goods should come up. Like basically, where should retail read towards that? Nothing is related to buy or sell or taking the portfolio discussions.
So I would say that the economic data that you should track would be consumption growth, capacity utilizations, announcements by corporates about increasing capacities, right? Order book growth, ICOR, incremental output ratio, right? These are the fundamental factors which you should read, because that will then give you the play in terms of the fact that the capital goods sector will then pick up, right? So, but you have to read all of these data, right? Capacity utilization should start heading past the 80% levels in the economy. So this is all what I will be tracking very importantly. Second aspect is that whether you like it or not, you have to track IT, because if you have invested in any diversified mutual fund in India, right, they have exposure to IT. So your fate, whether you like it or not, you may be negative on IT, but your fate, it's like one Vikram Vetal. It is there on your neck. 10 lakh crore is the industry's exposure to IT today, above industry. So whether you may say I am negative on IT and all of that, but you're already your existing portfolio is exposed to IT, whether you like it or not. So in your own interest, you track the IT sector, see what's happening on layoff. And I'll give you a very contra thinking, right? The company which I will look at is the one which announces layoffs. Okay?
Right.
Because in the AI world, okay, there is no way, right, that you need this level of labor. And the more these companies delay that process and allow it to go on, right, it's bad. So you have to wish ko pina hai. You have to take the poison pill. So the companies which are aggressive in terms of uh, very selective hiring, only AI ready kind of a new individuals coming in, but who are willing to lay off their mid management with severance pay and say Niccolo Judd say is not good from an economy. It will be bad headlines on top. But the companies which does that are the ones which are by their actions demonstrating that they're getting ready for the AI world. So it's a very contra way of looking at it, but that's the way I would bet, right? And I don't know which company is going to do that, right? We have no idea. Nobody is even talking like that. Okay, so but they will. One of these days it will happen, and that to me is the company which is showing its readiness. So IT you have to track whether you like it or not. Like because everybody has got an exposure to IT because of their mutual fund, right? And apart from that, I would still say that uh, banking BFSI as a space, right? Uh, to the extent I would say, though in the war time it has actually corrected, it is ultimately the growth engine of the country. Okay, so there could be a lot of corrections on the way forward, but from a medium term outlook, I would still say that you track the NPA levels of the banking system. You track the penetration of insurance and mutual fund because in the BFSI space, you have non-lending space also, AMCs, wealth management, broking companies, insurance companies, all of those. So they are also a good part of the growth story, right? So track the mutual fund penetration, see whether those numbers are going up, SIP book. Then this BFSI is a good play, but with the proviso that there could be much more correction in the months ahead, but ultimately it should stabilize and things should get better. So I would say BFSI should be a very important part of your tracking, but the entire space. So lending means you look at gold loan companies, you look at microfinance companies, you look at private banks, you look at small NBC, big NBC. So there are a lot of trades to track, but you have to track because that is the temperature of the economy is seen from the banking system. बुखार है कि नहीं इकोनॉमी को बैंकिंग सिस्टम से पहले पता चलता है. So I would say people should track that. And so if you see the signals going nicely there, then that's a sector on which you can start accumulating. But keep it diversified across lenders and non-lenders.
Right. Yeah. One next question, again, we will keep it short. The question is, what are the criteria that FIIs or maybe even mutual funds, PIs, enter a micro cap or a small cap as a segment?
Criteria means what? See, first of all, the nature of the fund decides that, right? So I would say only mid cap and small cap funds will first of all look at small caps and micro caps. No large cap fund will go beyond mid caps. 80% anyway has to be large cap and large cap fund. Even a large and mid cap fund, I would say that they would tend to have not more than 5% in small cap itself, right? So flexi cap will also not touch micro caps to any significant degree. So take out these three. If you see the flows of last year, the 25% of the industry's flows was in flexi cap, 12% was in large and mid cap. So that's 37%. Another 6-7% was in large cap. So 43. So 40% of the industry anyway doesn't look at it. Okay. So now flows into mid cap and small cap funds were about 13% each. So quarter of the industry only looks at mid and small cap. Within that, if you see, many fund houses don't go beyond the 500 or 1,000 stock, but there are some who take these calls. So within the mid and small cap funds, right, when they look at micro cap and small cap, the fund manager, because he's got a peer level comparison and a benchmark to beat. Benchmark doesn't go beyond these stocks, right? The BSE 500 or whatever, small cap 250 or whatever they choose doesn't go beyond this universe. So when they go beyond the universe to pick stocks, they are taking a high risk bet. So they will compensate it with a safety element in their portfolio so that they are not completely caught off guard. Those fund managers who do that get rogered very badly in bad times and then they superbly perform in good times. But there are very few that way, right? Because you have constant pressure from the sales team saying your performance is not comparing, sir. Stay. So why I'm saying this is, so such funds will always build up. A small cap fund itself may have 10 to 15% large caps in it because he needs to counterbalance the high risk of going into micro cap with the large cap. And second is from a liquidity perspective, SEBI has now come down very heavily on them saying that you need to have this minimum liquidity. Now that liquidity can come by sticking within the BSE 500 stocks or it can come by going down, but building up a greater large cap and more liquid mid cap stocks in your portfolio. So why I'm saying this is, so based on that, if they have a good buildup of large caps and large mid caps in their portfolio, then they go and look at micro caps and very small caps. The criteria they use are first and foremost corporate governance. We all else is waste. First is the corporate governance of the promoters and the directors and the way they have done their business. And they do this with a trade check with their buyers and their suppliers. And they do this by making sure they visit the plant of the company in addition to the head office of the company. So all this due diligence that I said is about corporate governance. That's number one. Number two, what they look at is this business scalable? Which means that either geography-wise or product-wise, that product that this company, because it's been doing well, that's why it's come into the stock market itself, can it scale up? So the scalability is a second. So corporate governance is first, because when it scales up, I'm buying a micro cap because I hope it will become a small cap and a mid cap in its time frame. No, if it's going to remain a micro cap, then kya faida, right? So I need to look at the scalability of that one. Third aspect is I want to see whether he has an entry barrier. Does he have a unique selling proposition? Does he have a technology which others can't access? Does he have a geographic advantage which nobody can access? Does he have a customer base which other people can't access? Like he's got a tied arrangement with a big buyer, which is ironclad in guarantee. So because only the entry barrier can give superior profits. For me to compensate the higher risk of a micro cap, I need that superior profit generating capability of that company, right? So I will look at that as a big thing. As does he have entry barriers or a protection from his business, either in whatever in terms, right? And that shouldn't be a price driven thing, because price can always be matched and beaten. It is not sustainable. So somebody says I'm selling a product cheaper than others, right? That I will say is not okay. That's the third aspect. The fourth aspect is the four things I would say. Again, it's may come into corporate governance, but I will still carve it out separately. One is that what is the degree of promoter holding in the company and the promoter behavior on his holding, which means how much is he leveraging his holding, right? How much is he going and pledging his holding to raise money, right? So that's one big red flag if that's very high. Second is, so the higher the promoter holding, right, it's a negative because it means the free float is less. Because then the higher the promoter holding is looking at more like his personal family company. और जो चाहिए वो corporate governance में कुछ भी कर लेता है, right? So the more he has let go and allowed other institutional shareholders and retail shareholders to participate, right, the better, because then the free float of the stock improves. So it's to do with the free float, right? That's the second aspect. The third aspect is what is the debt equity ratio, right? So which also then coincides with his dividend paying plan, because if he's got a higher promoter shareholding, then he will be tempted to give high dividends to give back to his family and friends as money rather than investing in his business. And then he'll be tempted to borrow, because to every promoter, debt has got a interest which is tax free, equity has got a dividend which is pre-tax. So there's a big tax advantage to debt because they're tempted to then take more debt. But the debt equity is key because the nature of the business of any small cap and micro cap is high operating and financial leverage. Financial leverage is nothing but debt equity. Operating leverage comes from high sales force cost, fixed cost, which means he cannot change. This variable nahi hai. He's got to have India-wide network of offices. He's got to have India network set of employees. He has to pay salary to the employee, whether he's gaining market share or losing market share, his sales are growing or not growing. So high operating leverage and financial leverage. Because of that, the debt equity ratio, if it's already high operating leverage, then he should not have too much financial leverage, because he's adding on another fixed cost to already fixed operating cost. Because then what happens, a small 2 rupees rise in the selling price of his product can maybe lead to a 10 rupees rise in his margin or in his profits. But the reverse is also true. A 2 rupee drop in his selling price will take him straight from this to loss. So that's a very high risk, high reward. I want to take the high risk from the nature of his business, not from what he's doing with his money. So for me, financial leverage, the more conservative the financial leverage, the debt equity ratio, the better, because the business risk, he has to take risk to get reward. So I'm comfortable with a micro cap and a small cap, willing to take risk in his business, expand, invest in capacity before the time is due, because it'll pay off.
some bets may pay off, may pay off. That's worth it. As a stock, I take a risk. He's taking a risk in his business. But if he's playing around with debt equity and just trying to live on borrowed money, you have a number of companies which had fantastic businesses. They borrowed too much and they collapsed. Right. So I think
Right.
to summarize, these are the factors that as I would look at in a small and micro cap.
Great articulation, sir. Matlab, again, you basically the parameters that one need to see. Again, as a retail investor, what we see is basically the shareholder should be higher side, right? Promoter should own the higher, more than maybe 60-65%. But how the institution see it's from a very different lens, and it's a great angle to get in. So I think the next question we have already covered with sector in the tailwind. Again, no one can say which will be in tailwind, but you need to check the macroeconomic parameter that's are already mentioned. Then the last question for today, again, we have been running for almost 90 minutes now. So last question is right on the behavioral side, how the retail investor we should not fall for the narrative that is currently going on in the market and make more rational so that we bring a lasted wealth.
So I think the main thing to take on mind as a retail investor is that good times don't last and bad times don't last. Right?
Right.
So we are going through a bad time, undoubtedly, as an economy because of the war or oil situation is hitting us. As an economy, the AI readiness is hitting us in terms of air force. We are going through a challenging time, but these don't last. Number one. Number two is the fact is that nobody ever predicted the perfect top or the perfect bottom. Remember that. The best of investors, nobody's done that. So given these two factors primarily in mind, I would say that when bad time comes, do not panic sell, accumulate. When bad times come, do not throw lump sums at any time because you can't get the perfect bottom, but always stay staggered. So in a bad time, always stagger your investments. The third is what I already said, never try to pick winners in a bad time. Like we talked about the sectors, because of the fact that the market is an unpredictable beast, right? International investors are unpredictable. You are not living in a cocoon. India's situation may be very good in particular thing, but other countries may be better. India's situation may be very bad in something, but other countries may be worse. So what we think as a disaster to a foreign investor may be saying it's not as much as a disaster as X other country, right? So you sitting
Right.
here in India with this cannot sit and think like an FII to see what it does to India. So do not try to guess the sectors. And again, as an example, I will say, classic narrative around gold. Right? Gold is a safe haven. In times of war, gold rises. क्या हुआ इस बार? Because gold had already risen pre-war, and during the war time, the dollar became the safe haven. So narratives like this don't everything last for you can just they can't take a textbook approach and say, oh no, the day the war broke out, a lot of people went and bought gold. And immediately gold corrected because it's a different play. So all I'm saying is, so my final third point is during the bad times, in whatever be the narrative, stay diversified. Part one. Part two, do not change your asset allocation during a bad time. You had a particular asset allocation before the bad time started. Correct? Stay all these rules, staggered, no lump sums, accumulate, but diversified in the same proportion that you had thought it wise when the situation was calm, with your long-term goals in mind, because bad times never last. And so your goals cannot be, yes, it may get affected if the time that your goal matures, it was a bad time. But you and I can't sit here and predict that. So you prepared for your long-term goals on a steady state basis. Believe that when your goals come to life, when they come to mature, life will be in a steady state basis, and stay invested on that basis. Do not allow this narrative bad time to alter your asset allocation.
Right.
Those are my brief pointers.
Right. I think sir has answered beautifully, and the person who asked the question got the good understanding of how one should stay rational. So with that, like that was the last question, sir. Again, we have been going on for more than 90 minutes now, right? And again, your the way you think and the way you helped us in navigating through, you have explained it beautifully, right? And what stands out is it's like not just your depth, it's basically your ability to basically show us a lot of different angles which a retail investor can't even think of, right? And again, that's why, right, I will recommend your YouTube channel, right, so that people should go and uh, gain some knowledge from thing, right, how people should think about their investing as a yeah. So on behalf of everyone and from Alphawealth team, right, it's heartful thank you for you. And ladies and gentlemen, we will wind up this session. Thank you so much, Sunil sir, for being there. Right. It was a great interacting with you.
Thank you, and all the best to everybody. Happy investing, and wish you
Thank
all
you
the best.
so much.